very good day to everyone, and thank you for joining us today. And welcome to our Boardroom Forum Live. We are going to be exploring ESG disclosure requirements, and in particular, welcome to episode 2 that deals with international and local environmental tax developments, and sharing some perspectives with you on that. And with me is Jason Daniel. He is a tax manager in our practice and also our environmental tax lead. So welcome, Jason.
Thank you for having me.
You're welcome. So we dive straight into it. Good. So what's new on the green tax development locally and internationally?
Yeah, it's a really interesting question, Werner. So locally, we saw the introduction of carbon taxes in 2019, and taxpayers grappling with the introduction of carbon taxes. And traditionally, when carbon taxes were introduced, a lot of taxpayers thought that carbon taxes would be predominantly around areas like mining, highly industrialized sectors. And once they've come to realize now that something as simple as having a certain amount of generators as a result of load shedding would require them to report both to SARS and to the Department of Environment, Forestry and Fisheries on the emissions resulting from their activities. So it's really a fast-moving area. National Treasury is focusing a lot on environmental taxes, carbon taxes, and we saw with the latest Taxation Laws Amendment Act that came in late last year that they're really ramping up the rate. So National Treasury is looking to increase the carbon tax rate as it currently stands at 159 Rand to around 462 Rand within the next 8 years. So a significant increase in the carbon tax rate. And on a global scale, we're seeing lots of jurisdictions adopting environmental tax legislation. The most poignant and most significant one at this stage is the Carbon Border Adjustment Mechanism that the EU is looking to introduce. It's colloquially known as CBAM, and that's set to commence on the 1st of October of this year. And that's a big step where we're seeing that jurisdictions are looking to tax where emissions are produced, even if the taxing authority is not necessarily where the emissions have arisen.
Right.
It's a very interesting space at the moment.
Maybe can you talk a little bit more about the implications of CBAM on organizations?
So from a South African perspective, taxpayers who import into the European Union would need to be very mindful of the introduction of the Carbon Border Adjustment Mechanism, or the CBAM regulation. So newly adopted, just last month we saw the regulations published in the EU Journal, and it must have been about a week ago we saw the implementation rules being gazetted by the European Union. So taxpayers have now about a month to comment on those implementing rules. But in essence, what the CBAM aims to do, and what it really aimed to prohibit, is that taxpayers were setting up shop outside of the European Union. So what is colloquially known as carbon leakage.
Right.
These manufacturers would set up shop outside of the EU and then circumvent the carbon price by re-importing those goods back into the EU. So avoiding the EU ETS, or the European Union Emissions Trading System, and the implications that would have on their production and the emissions arising from their production. So in essence, it's really a customs duty, if you will, on goods being imported into the EU from jurisdictions that don't have a carbon price locally.
Right.
So it's really important at this stage from a data perspective that taxpayers are aware of their trade statistics, where those goods originate from, the classification of their goods. So it's very customs heavy driven exercise to understand the types of goods that are being imported into the EU. So from the 1st of October, we're seeing a transitional phase where a certain type of goods, for example, electricity, fertilizers, iron and steel, aluminium, those are the real sectors that are being targeted initially during this transitional phase. And taxpayers will be required to report on the emissions in those goods, both indirect and direct emission sources, and the taxes that are those taxpayers are subjected to within their local jurisdiction where those goods are produced to the European Union. So a really bold move by the EU as part of their Fit for 55 package as they transition to climate neutrality.
Right. And just listening to you, potential taxes from a CBAM perspective, and what if I'm already paying, local carbon taxes in South Africa, for example?
I mean, it's a very interesting question because the implementing rules are still in draft format at this point in time. But one would need to understand that from a CBAM report perspective, one would need to report on the goods or the amount of goods that are being produced in and imported into the EU, the carbon embeddedness within those products. So that's both direct emission sources and indirect emission sources. And then finally, the carbon tax or carbon price paid in local jurisdiction where those goods are actually produced.
Right.
The key difference around CBAM versus carbon taxes in South Africa, from a carbon tax perspective in South Africa, taxpayers are only subjected to their scope 1 direct emission sources. So emissions from fuel combustion activities, from fugitive emissions, from industrial process emissions. And that's really what taxpayers are taxed on from a local carbon tax perspective. Whereas from a CBAM perspective, we're seeing that it's not only direct emission sources, so your scope 1 emission sources, but also indirect emission sources. When we're talking indirect emission sources, we're thinking things around purchased electricity, for example, emissions upward, downward stream throughout the supply chain. And it's really indicative of the fact that come the start of 2026, which is in essence the start with which taxpayers would need to surrender their CBAM certificates from a EU perspective, and similarly so the start of the second phase of carbon tax, it's highly likely that we'll see that Eskom, who's currently, through a carbon credit, there's carbon neutrality of a sense for their liability from a carbon tax perspective. So it's highly likely that come the start of the second phase of carbon tax, the start of January 2026, Eskom will be subjected to carbon tax. And the impact that that'll have on taxpayers and South Africans at large will be massive.
Indeed. Maybe can we comment a bit on some of the green tax incentives offered by the South African government?
Sure. I mean, that's a topical area. Robust discussion during the last public consultation process with National Treasury. And that's really on the top of a lot of taxpayers' minds, is to understand, well, there's a lot of the stick approach from government in the way of disincentivizing so-called dirty energy sources and poor behavioral choices by taxpayers through the activities and the emissions arising from those activities. But where's the carrot? I mean, what is National Treasury doing in the way of incentivizing taxpayers to make those changes? So we saw recently there was the expansion of the the capex allowance insofar as Section 12B is concerned. So the original energy incentive was capped at 100%, whereas now we're looking at an increase or an expansion to around 125%, so 125% capex allowance. And I'll illustrate this probably by way of an example is best way to illustrate that. But in essence, it's to encourage investment within renewable energy, so the installation of capital infrastructure to generate renewable energy, either through wind, through hydropower, through solar, for example. And in essence, a capital investment of, say, around R1 million by a taxpayer would afford them a deduction of around 1.25 million, which in essence results in around a tax benefit of around 340,000 odd. So we're seeing that capex allowance being expanded from 100% to 125%, really trying to encourage renewable energy infrastructure within that space. We also saw, I'm sure that you would have heard on the radio and by the media, that there was the rooftop solar panel allowance offered to taxpayers. So that's capped at 25% or 15,000 rand really for that infrastructure that's installed for solar panel purposes. You have the sunset date being extended out until the end of 2025 of the energy incentive, so Section 12L, where a taxpayer year on year improves on their energy efficiency, and they'd be able to reduce their taxable income. So really, some measures put in place by National Treasury. I think it begs the question in many taxpayers' minds is whether enough is being done by the government to incentivize investment into this area, and encouraging the uptake of renewable energy sources, and to drive that transition to a greener economy.
And just turning our attention a bit to some of the JSE listed, they've been providing disclosures on carbon tax, as well as some of their carbon tax strategies. How do you see this develop? Surely there's a lot more to be reported there in terms of the potential value add as part of that process.
So, I mean, off the top of my mind, the first step, it really is encouraging to see taxpayers disclosing on environmental taxes as a first step. So it's not a mandatory disclosure requirement at this point in time. It's very voluntary. And it's an encouraging step to see taxpayers disclosing on the environmental tax liabilities. What taxpayers should be cautious of is when they're disclosing environmental tax liabilities, for example, there needs to be actionable steps that have been put in place. So take, for example, a company that discloses on their environmental tax liability year on year. Stakeholders won't see improvements on their liability reduction. If they don't see, or rather if stakeholders don't see improvements on a carbon tax liability year on year, and you're seeing it plateau and there isn't a decline in the taxpayer's environmental tax liability each year, it really is tantamount to greenwashing of sorts, given that there isn't actionable tasks and steps put in place by taxpayers to reduce their total emissions, and by reducing their total emissions, ultimately reducing their carbon tax liability. So, I mean, a lot more can be done in the way of disclosures, at least on a voluntary basis. We can take steps and look towards, for example, the EU Corporate Sustainability Reporting Directive. We can look at, for example, the US Securities and Exchange Commission, and really in those reporting disclosures, we're seeing that they encourage taxpayers to disclose information around the risks, around the opportunities, and the actual impact of their activities, and really what the impact of those activities have on society at large, on stakeholders, and on the environment.
Jason, and just in closing, what shall we look forward to from an environmental tax development perspective?
Yeah, I mean, there's lots to look forward to. It's a fast-moving area. The target's always moving. Lots of steps been taken by National Treasury, both local National Treasury and jurisdictions abroad. We're seeing the implementation of a number of environmental tax regimes being introduced on an Africa scale. We're seeing a lot of African territories considering the uptake of carbon pricing, carbon taxes. I mean, we saw the EU Green Deal industrial plan, so that's part of the Fit for 55 package. So the CBAM that we spoke of throughout this forum was really just one of many mechanisms that the EU is looking to introduce within their regulations. So we have the EU Green Deal industrial plan, which aims to bolster the environmental credits, and provide some form of incentivization for taxpayers within the climate neutrality space. We saw the expansion of the EU ETS recently, where we're seeing the inclusion of the aviation, the maritime sector space. We're seeing the built environments being included in the EU ETS. So again, this widening of the net by jurisdictions and regulatory bodies to try and see where they can encompass environmental taxes. We saw the US Inflation Reduction Act being introduced, and that comes with it a host of tax credits, incentives, again, to encourage this behavioral change to uptake in, investment within renewable energy, infrastructure. So lots on the horizon. We're seeing the OECD, for example, who have released any number of reports on carbon pricing, carbon taxes within the recent years. And the OECD have recently indicated that they want to encourage international dialogue within the space and looking to get a mandate from the G20, similar to the current inclusive framework that's currently focusing on BEPS Action 1, so on the digital economy. Once they close out that, they're looking to look to a potential multilateral instrument to introduce a global minimum carbon price. So again, very interesting, and it's really a watch this space at this point in time.
Very much so. Jason, thank you very much for sharing those insights. Certainly a very interesting and fast-moving space for us to stay on top of and keep engaging on. Jason, thank you very much for sharing those insights. Really appreciate it. And thank you very much for joining our Boardroom Forum Live. Our next episode will cover a practical view on social requirements for the mining industry. And please join us for that as well. Thank you very much. Bye.